Two venture capital firms are about to collect more than $130 billion from a single stock offering. They've been waiting 18 years for this moment. They need a buyer. And Elon Musk just announced that buyer is going to be you. SpaceX is going public. Ticker SPCX. Valuation $1.75 trillion, the largest IPO in the history of financial markets. And in a move the press is calling unprecedented, Musk is offering 30% of those shares directly to retail investors, to regular people, to you. 3 times the industry standard. That's not generosity, that's a floor. Consider someone like Dana, registered nurse, outside Denver, Colorado. She makes $74,000 a year. She has $18,000 in a brokerage account she's been building for 6 years, her version of a retirement cushion. When she hears that SpaceX is going public and that regular people can buy in at launch, she feels something she hasn't felt about investing in a long time: excitement. She's being told this is her chance to get in early, to own a piece of something historic, to be on the right side of this trade for once. What nobody tells Dana, what the press releases won't say, is which side of this trade she's actually on. And this didn't happen by accident. By the end of this video, you will understand exactly how an IPO exit works, who sells, who buys, and what the staggered lockup schedule embedded in SpaceX's own prospectus tells you about what happens the moment you click buy. Here's how we're going to get there. First, how a venture capital exit actually works. Not how it's explained in a press release, how it actually works. Second, who is cashing out of SpaceX, how much, and when. Third, what the prospectus actually says about your voting rights, the company's losses, and the lockup windows that begin opening weeks after the IPO. And fourth, what this means for Dana's $18,000, and for yours. Here's how the system works against you right now. SpaceX has announced that most insiders, the venture capital firms, the early employees, the long-tenured shareholders, will not be locked up for the standard 180 days after the IPO. Instead, they negotiated a staggered release schedule that begins with the company's first earnings report, expected in July or August 2026. At that moment, up to 20% of insider shares unlock immediately. If the stock is trading 30% above the IPO price, another 10% unlocks on top of that. Then it gets more granular. 5 additional tranches at 70, 90, 105, 120, and 135 days after the IPO, each releasing another 7% of eligible insider shares. By the time a typical retail investor has had the stock for 4 months, insiders will have had multiple legal windows to sell into the market. And statistically, the buyers on the other end of those insider sell orders will be retail. But this wasn't always how IPOs worked. And to understand why this structure exists, you have to understand what venture capital actually is, and what it's always been designed to do. Venture capital was born in the years after World War II, a mechanism to funnel private capital into high-risk companies that banks wouldn't touch. The model was simple: invest early, absorb the risk of failure, and capture enormous returns if the company survived and grew. For most of VC history, an IPO was the designed endpoint. The company goes public, the early investors get liquid, the public market takes over the price discovery. That is not a conspiracy, it is the intended function. What mutated was the timeline and the scale. Founders Fund wrote its first check to SpaceX in 2008. That is 18 years ago. In venture capital terms, that fund cycle closed a decade ago. The limited partners, the pension funds, the university endowments, the family offices that gave Founders Fund their money, have been waiting for their returns. At a $1.75 trillion valuation, Founders Fund's stake is worth more than $60 billion. Valor Equity Partners holds roughly 4%. worth approximately $70 billion. Sequoia, which came in later, stands to collect more than $20 billion. Together, those three firms hold over $150 billion in SpaceX equity that has been illiquid, meaning they could not sell it until the moment a public market exists. The IPO creates that market. The 30% retail allocation fills it with buyers, and the staggered lockup begins the transfer. Let's slow this down and make it concrete, because this is the block where the mechanism becomes unavoidable. Imagine you built a house in 2008. You built it with your own money in a neighborhood nobody wanted to live in. You held it through floods and fires. You maintained it for 18 years, and now the neighborhood has become the most desirable zip code in the country. You want to sell, but here's the problem. You can't just sell a private share of a private company the way you sell a house. There's no open market. You need a buyer pool, a deep, liquid, enthusiastic buyer pool, large enough to absorb a $150 billion position without crashing the price. That is what a public offering creates. That is what the 30% retail allocation is designed to build. Here's the step-by-step of how this plays out. Step 1. SpaceX sets the IPO price. The price is not set to reflect fair value. It is set to maximize the raise, to generate the most capital from the most buyers at the highest price the market will absorb on opening day. Step 2. Retail investors, guided by media coverage, brokerage marketing, and Musk's loyal base, buy shares at or above that price on opening day. The excitement is real. The demand is real. The price is set by people who are not you. Step 3. The company reports its first quarterly earnings in July or August. The first insider unlock window opens. Venture capital firms begin selling shares into the market, legally, cleanly, exactly as the prospectus allows. Step 4. Every 30 days after that, another tranche unlocks. The insider sell pressure enters the market in waves. If retail holders are still buying, or simply holding, the price is supported. If they start selling too, the price falls. That last part is the whole game. The strategy, as reported directly to Wall Street by SpaceX's own CFO, is to leverage Musk's fan base and loyal backers to help stabilize the stock following its market debut. Stabilize, that word. What does stabilize mean in this context? It means hold the price up. It means don't sell. It means be the floor that insiders sell into without the price collapsing. The CFO didn't say that to scare you. He said it to reassure institutional investors, the big money accounts, that SpaceX has a retail base loyal enough to absorb sell pressure without triggering a downward spiral. You are not the investor. You are the stabilizing mechanism. Now let's look at the actual business they're selling you. Because this is where intellectual honesty requires a harder look. SpaceX generated $18.7 billion in revenue in 2025. That's real. That's a 33% increase over 2024. The business is growing. But the net loss in 2025 was $4.9 billion. And in the first quarter of 2026 alone, one quarter, the net loss was $4.27 billion. 1 year earlier, Q1 2025, the net loss was $528 million. In 12 months, the quarterly loss grew by more than 700%. That is not a company marching toward profitability. That is a company where losses are growing faster than revenue. The company carries an accumulated deficit, that's the total of all losses since founding, of $41.3 billion. Here's the three-part structure of what you're actually buying. Starlink, the satellite internet division, generated $11.4 billion in revenue in 2025 with $4.4 billion in operating income. This is the engine. This is the only segment making money. Without Starlink, SpaceX is a rocket company burning cash. The space segment, launches, Starship development, generated $4.1 billion in revenue with a $657 million operating loss. Rockets are expensive, margins are thin, and Starship has yet to achieve the full reusability that its business model depends on. And then there is SpaceX AI, the artificial intelligence division integrated with Musk's XAI project. This division lost $6.355 billion in 2025. In the first quarter of 2026 alone, it lost $2.469 billion. You are being asked to value a company at $1.75 trillion, while one of its three core business segments is burning through $6 billion per year with no disclosed path to profitability. And there is one final detail buried in the governance structure. The dual-class share structure gives Musk and select insiders 10 votes per share. You, as a public shareholder, get 1 vote. You have no real governance power over any decision this company makes. None. Here's how SpaceX is selling you this deal. They are telling you that the 30% retail allocation is democratization, that Elon Musk, a man worth hundreds of billions of dollars, has decided that regular Americans deserve a seat at the table, that this is the people's offering, that for once the little guy gets in early. And the financial press has largely repeated that story without reading the fine print underneath it. Here's what the fine print actually says. The 30% retail allocation is being distributed through Bank of America, targeting wealthy retail clients and family offices. Morgan Stanley's E-Trade platform for smaller retail participants, and UBS and Citi for international retail buyers. That is not a charitable distribution. That is a distribution infrastructure, a logistics operation designed to channel as much capital from as many individual buyers as possible into this offering. Why does scale matter? Because institutional investors, the major pension funds, the sovereign wealth funds, the big endowments, do not provide permanent support for a company with accelerating losses, a $41 billion accumulated deficit, and a governance structure that gives them no meaningful vote. Institutions are sophisticated sellers. They rotate out when the risk calculus changes. Retail investors tend to hold. Retail investors bought into the story. Retail investors feel personally connected to the brand. Retail investors are the floor. And here is who benefits from that floor. Founders Fund. Peter Thiel's venture capital firm, which wrote its first check to SpaceX in 2008. Projected gain, more than $60 billion. Valor Equity Partners, run by Antonio Gracias, a SpaceX board member, who has spent years accumulating roughly 4% of the company. Projected gain, approximately $65 to $70 billion. Sequoia Capital. They came in at a $36 billion valuation in 2020, already late by VC standards. Projected gain, more than $20 billion. These are not paper gains they plan to sit on. These firms have fund cycles, structured commitments to return capital to their own investors within a defined window. Those windows are open. The prospectus gives them the mechanism to execute, and the 30% retail allocation provides the buyer pool to sell into without crashing the price. This is not a conspiracy. It is not a crime. It is the designed function of the American capital market, a system built to transfer risk from informed, long-tenured insiders to optimistic, late-arriving public buyers. The only question is whether Dana knows which side of that transfer she's on. Now, fairness demands we hold the other side of this. Because the strongest version of the bear case is not one that ignores the bull case. It's one that understands it and still reaches the same conclusion. Here's the honest case for buying SpaceX at IPO. Starlink is not just growing, it is compounding. 50% revenue growth year over year, $4.4 billion in operating income from a single division. In rural America, in sub-Saharan Africa, in the Indonesian archipelago, there is no competitor at scale. Starlink is, right now, the only viable satellite broadband option for hundreds of millions of people. That is a monopoly in formation, And monopolies, historically, are very good for shareholders. The launch business, despite losing money today, holds an infrastructure advantage that no competitor can replicate quickly. Reusable rockets change the cost equation for putting mass into orbit. If Starship achieves full reusability, and there is real engineering evidence suggesting it will, the economics of space access change permanently. SpaceX would not just operate the highway, it would own it. And SpaceX has something most money-losing companies do not: a government revenue floor, deep contractual relationships with NASA and the Department of Defense, under an administration that has shown no appetite for reducing its reliance on SpaceX. Provide a baseline of predictable revenue that most startups never see. These are real arguments. Serious investors make them with a straight face, and they might be right. But here is the one question those arguments cannot answer. Amazon was a genuinely world-changing company in the year 2000. Its stock peaked at $106. It took 9 years to return to that price. The investors who bought at peak hype were not wrong about Amazon. They were wrong about the price. You are not being asked whether SpaceX is a great company. You are being asked whether $1.75 trillion today is the right price for it, at a moment chosen not by you, but by the people who need to sell. Remember that $130 billion figure from the top of this video, the amount Founders Fund and Valor alone stand to collect from this IPO. Here's exactly what that looks like from the other side of the trade. Dana, registered nurse, Denver, Colorado. $18,000 in a brokerage account. Dana buys $10,000 of SPCX at the IPO price. Opening day is electric. The stock climbs 15% in the first session. Her position is up $1,500 on day one. 6 weeks later, SpaceX releases its first earnings report. The loss for the quarter, $4.27 billion. The unlock window opens. Insider shares enter the market. The stock gives back 8% in a week. Dana is now down on her original position. She holds because she believes in the mission. That is the stabilizing mechanism. Marcus, high school teacher, Phoenix, Arizona, $6,000 in a Robinhood account. Marcus puts $3,000 into SPCX on launch day. He doesn't read the prospectus. He watches the news coverage. He sees the rocket launch in the background of every financial segment. He buys the story. By month 4, 5 of the 7 staggered unlock tranches have executed. Insider selling has absorbed $40 billion worth of public market demand. The stock is trading 12% below his purchase price. Marcus is down $360. Not catastrophic, but it's money he earned, not money he was ever supposed to risk this way. The retired couple in Columbus, Ohio, $22,000 in a self-directed IRA. They buy $15,000 of SPCX because their financial advisor described it as a generational opportunity. They do not know what a lockup tranche is. They do not know what exit liquidity means. They know SpaceX. They've watched the rockets land, and now they own a piece of it. What they own, technically, is 1 vote for every 10 that Elon Musk holds, and a share in a company losing $4 billion a quarter, and a position that will face programmatic insider selling for the next 6 months. Here's what the ledger says. The SpaceX IPO is not a fraud. The rockets are real. Starlink is a real and growing business. The mission, however you weigh it, is genuinely held. But the transaction being offered to you is not the transaction being described to you. The 30% retail allocation is not democratization. It is load-bearing infrastructure for a $150 billion insider exit. The staggered lockup is not flexibility. It is a scheduled transfer of sell pressure onto a retail base that was specifically chosen for its loyalty and its tendency to hold. The dual-class share structure is not efficiency. It is a governance wall that ensures you have capital exposure and zero influence. Founders Fund, Valor, and Sequoia didn't take the risk so you could share in the upside. They took the risk so they could hand it to you at the price of their choosing, on the schedule of their choosing, through a distribution network built to make you feel like you were finally invited in. The ledger is not sentimental. It doesn't care about the rockets. It reads the numbers. And the numbers say, you are the exit. If this is the first video you've landed on, this is what we do here. The story underneath the story. Subscribe to American Ledger Journal. Hit the bell so the next one finds you. And if this gave you something worth passing on, send it to someone who needs it.